Something just snapped in the silver market, and if you blinked, you missed a move that usually takes months. I'm talking about silver collapsing from $121 down to about $71 in what looks like a forced liquidation washout, and then this is the part that should make you pay attention, ripping back to nearly $90 in hours. That's almost a 12% move in a single day, February 3rd, while Shanghai never really broke, holding closer to $95 to $100 the entire time. And both macro desks and metals traders are now saying the same thing. This wasn't a demand collapse. This was a leverage event. Stay with me, because I'm going to show you why this rebound isn't random, how to recognize this setup yourself next time, and what levels you should be watching right now if you don't want to be reacting late. Before I explain what caused this, let me teach you something most people never really internalize about markets. Prices don't just reflect value, they reflect positioning. Think of it like a crowded theater. Everything feels fine until someone yells fire, and suddenly the exit matters more than the movie. In silver last week, leverage was the crowd, and margin was the exit. When conditions change fast enough, price becomes about who must sell, not who wants to. And if you understand that, you stop confusing forced selling with real weakness. That distinction is everything, especially if you're trying to stay one step ahead instead of chasing headlines after the fact. So what does that really mean for you? It means when you see a price crash like this, your first question shouldn't be what's wrong with the asset. Your first question should be who's being forced out. Because markets aren't just information processors, they're liquidation engines. And the thing is, forced sellers don't care about fair value. They care about survival. They'll dump at any price to meet margin calls, to avoid getting liquidated completely, to stop the bleeding. That creates opportunities for people who understand what's happening. Not manipulation, not conspiracy, just mechanics. Now here's where this gets interesting. Most retail traders, they look at a chart that drops 40% and they think the asset is broken. They think demand disappeared. They think something fundamental changed. But professionals, they're looking at something completely different. They're asking whether the selling is voluntary or involuntary. They're checking whether physical markets are holding or cracking. They're measuring whether the move makes sense based on fundamentals or whether it's purely technical. And in this case, every single one of those signals pointed the same direction. This was a positioning flush, not a fundamental breakdown. If this is making sense, drop a comment below and let me know where you're watching from. I want to know if you're holding silver, if you got shaken out, or if you're sitting on the sidelines trying to figure out what just happened. Because the way you interpret this move is going to determine whether you see what comes next or whether you're constantly reacting to price instead of anticipating it. Here's what matters about positioning versus fundamentals. Fundamentals are slow. They're about supply and demand over months and years, industrial use, investment flows, mine production. Those things don't change in a day. But positioning can flip in hours. One margin hike, one liquidity squeeze, one cascade of stop losses, and suddenly you've got a 40% move that has nothing to do with whether people want silver or not. It's just math. It's just leverage unwinding. And once you see it that way, the whole move starts to make sense. Let me give you the analogy I use. Imagine you're at an auction. There's a painting everyone wants. Bidding is hot. Then suddenly one bidder gets a phone call. Emergency, has to leave, needs cash now. So he starts selling everything he brought to the auction, including the stuff he already won, just to raise money fast. Prices tank because he's dumping. But here's the thing. Nothing changed about the paintings. They're still valuable. It's just that one guy's personal crisis created a temporary price dislocation. That's what happened to silver last week. Someone, or a lot of someone's, needed out fast. And when they sold, it created a cascade. Now here's what's actually happening under the hood. The initial drop from $121 wasn't triggered by collapsing industrial demand or disappearing physical buyers. It was driven by aggressive leverage meeting higher CME margin requirements. When margins rise, anyone overextended has to post cash immediately or liquidate. So what happens? Selling feeds on itself. Price drops, margins get tighter, more positions get blown out, and suddenly you're staring at $71 silver, wondering what just happened. But here's the key. That selling has an expiration date. Once the forced liquidations clear, the pressure flips. Shorts start covering. Weak longs are already gone. And paper prices have to reconcile with physical reality. Let me walk you through the sequence step by step, because this is crucial. First, you had silver running hot, probably $121 with a lot of leverage behind it. People were buying on margin, using borrowed money, riding momentum. Then the CME, that's the Chicago Mercantile Exchange where silver futures trade, they raised margin requirements. Basically, they said if you want to hold your position, you need to post more collateral. Now, if you're already maxed out on leverage, you don't have more collateral. So you have two choices. Close the position or get liquidated. Most people chose to close. But when everyone tries to exit at once, there's no bid. price gaps down. And once it gaps down, more people hit their margin calls, more liquidations, more selling. It's a spiral. But here's the part that should make you pay attention. While all this was happening in Western futures markets, physical silver in Shanghai stayed elevated. We're talking $95 to $100, while spot in New York was crashing to 71. That spread, that divergence, that tells you everything. Physical buyers didn't panic. They didn't suddenly decide silver was worthless. They kept buying at higher prices because they understood this was a paper market problem, not a fundamental problem. And that's your signal. When paper and physical diverge like that, the paper market is lying. The physical market is telling the truth. So what happens next? Well, once the forced selling exhausts itself, once everyone who had to sell has sold, the natural buying pressure returns. Shorts who sold into the panic start to cover because they know this wasn't real. Buyers who stayed patient start stepping in because they see value. And here's the thing about these snapback moves. They're not gentle. They're violent because all the weak hands are already out. So when buying shows up, there's no resistance. Price doesn't crawl higher. It rips. And that's exactly what happened. From $71 back to nearly 90 in hours. Not days, hours. Now let me show you what very few people are talking about. When you get a post-liquidation snapback like this, the market isn't neutral anymore. It's fragile in the opposite direction. Think about it. Anyone who sold in panic is now underpositioned. They're watching price rally without them, kicking themselves. Anyone who shorted late, thinking they were smart selling into weakness, they're suddenly underwater. They're trapped. And if momentum builds, if buyers keep stepping in, those shorts have to cover. And when shorts cover, they have to buy, which pushes price higher, which forces more shorts to cover. It's the same spiral, just reversed. That's why you're now hearing near-term upside chatter about $150 if momentum feeds on itself, and longer-term projections stretching toward $250 to $500 by 2026 if liquidity returns and physical demand stays firm. Are those guaranteed? No, but they're not coming out of nowhere either. They're based on the idea that this flush cleared out weak positioning, that physical demand never broke, and that if buying pressure returns, there's not much resistance between here and much higher levels. It's not prophecy, it's pattern recognition. This is the exact same playbook we saw in 2011. Silver was running, hit close to $50, then the CME raised margins, massive liquidation. Price collapsed to $33 in days. Everyone declared the trade dead. Media said the bubble popped, retail got shaken out, and then price violently rebounded once forced selling cleared. It didn't get back to 50 immediately, but it stabilized, held support, and proved the crash was technical, not fundamental. Same pattern, different year. Or look at March 2020. Liquidity crisis. Everything got sold. Stocks, bonds, gold, silver, crypto, you name it. Silver crashed from $18 down to $12 in a matter of days. People were panicking. Margin calls everywhere. Forced liquidation across every market. But once liquidity stabilized, once the Fed stepped in, once the forced selling stopped, what happened? Silver launched. Within months, it was at $30. That's a 150% move from the lows. Why? Because the selling was mechanical, not fundamental. And once the mechanics cleared, price had to realign with reality. Every time this setup appears, the sequence rhymes. Leverage blows out. Price disconnects from fundamentals. Physical markets hold. And then price snaps back fast enough to make late sellers question reality. It's not the same every time. The triggers are different. The magnitude varies. The timeline shifts. But the structure is identical. And if you know the structure, you can navigate the chaos while everyone else is freaking out. Here's what I want you to understand about this pattern. It's not specific to silver. I've seen it in oil, I've seen it in copper, I've seen it in Bitcoin. Any market with leverage, with margin requirements, with futures contracts, it can experience this same dynamic. Asset runs hot. Leverage builds. Something triggers a margin increase or a liquidity squeeze. Forced selling cascades. Price overshoots to the downside. Then once the selling exhausts, price snaps back. The universality of this pattern is why it's worth learning, because once you see it once, you'll recognize it forever. Zoom out and you see the larger story. These aren't crashes of belief. They're stress tests of positioning. The market is asking who's overextended, who's using too much leverage, who's going to break when conditions tighten. And once it gets its answer, once the weak hands are cleared, the market can move on. That's what happened here. This was a stress test. Silver passed. The question now is what comes next. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this fail? Absolutely. If $85 to $90 doesn't hold, if we see another wave of selling, if support breaks, the market can chop and frustrate everyone. We could trade sideways for months. We could retest the lows. Nothing is guaranteed. And yes, if global liquidity tightens hard, If central banks pull back, if recession fears spike, upside can stall. Silver is volatile by nature. It amplifies moves in both directions. So just because we had a violent rebound doesn't mean we're off to the races. Could this be manipulation? Maybe. I mean, people love to talk about manipulation in silver. There's a long history of accusations, lawsuits, settlements, big banks getting fined for spoofing. I'm not going to sit here and tell you markets are perfectly fair. But here's the thing. It doesn't actually matter whether some trader in New York was intentionally slamming the market or whether this was purely organic forced selling. The mechanics are what matter. Focus on what you can control. Watch the levels. Watch the reactions. Watch whether physical demand holds or cracks. That's actionable. Conspiracy theories aren't. And let's be honest, maybe I'm wrong. Maybe this rebound is just a dead cat bounce. Maybe we're heading lower. Maybe the bull market in silver is over and this was the top. I can't rule that out. Markets can do anything. But what I can tell you is that the price action we just saw, the divergence between paper and physical, the speed of the rebound, those are consistent with a liquidation flush, not a fundamental breakdown. That doesn't guarantee upside, but it does suggest this wasn't the end of the story. Here's what helps you navigate this. Don't trade narratives. Trade mechanics. Don't marry your position. Stay flexible. And don't confuse volatility with risk. Volatility is just price movement. Risk is permanent loss of capital. If you bought physical silver and it dropped 40%, you didn't lose anything unless you sold. The metal is still in your hand. But if you were leveraged and got margin called, that's real loss. Know the difference. Manage accordingly. There are probably 3 types of people watching this right now. Maybe you're holding silver and last week rattled you. You saw your position drop 40%, and you're wondering if you should sell, if you should hold, if you should buy more. If that's you, your job isn't to predict $500 silver. Your job is to watch whether $85 to $90 acts like a floor. That's your feedback loop. If price holds here, consolidates, builds support, that's a signal the worst is over. If it breaks lower and we head back towards 70, then you reassess. But don't make decisions based on fear. Make them based on what price is telling you. Or maybe you sold near the lows and you're feeling that knot in your stomach. You got shaken out at $75 and now you're watching it trade at $89 and you're kicking yourself. You're not alone. This happens to everyone. Even professionals get caught in these flushes. What matters now is how you respond. If price reclaims $95 to $100 and holds Shanghai parity, that's your signal that this move has legs, not just adrenaline. That's when you can consider re-entering if it makes sense for you. But don't chase out of FOMO. Wait for confirmation. Let the market prove itself. And maybe you're on the sidelines, skeptical but curious. You don't own silver. You're just watching this unfold and trying to figure out what it means. For you, this is about learning the pattern. Forced liquidation first, snapback second, trend decision third. That sequence repeats across markets. Gold, copper, oil, crypto, stocks, it doesn't matter. Leverage plus margin pressure equals forced selling. Forced selling equals overshoot. Overshoot equals snapback opportunity. Once you internalize that, you'll see it everywhere, and you'll be ready next time it happens in whatever market you're watching. The universal principle here is simple. Don't trade narratives. Trade mechanics. Narratives are stories people tell to explain price. Mechanics are the actual forces moving price. Margin calls are mechanics. Forced liquidation is mechanics. Physical versus paper divergence is mechanics. Those things are observable. Those things are actionable. So focus there. Ignore the noise. Ignore the hype. Ignore the doom. Watch what price does. Watch what flows do. Watch what the data says. That's how you stay grounded when things move this fast. So here's what I want you to answer in the comments. Are you holding silver right now? Did you buy the dip? Did you sell near the lows? Or are you sitting this one out? I'm genuinely curious where everyone's positioned, because that tells me how people are interpreting this move. And if you learned something new today, if this framework helped you understand what just happened, let me know. That's how I know what's landing and what I should cover more. Here's where I stand. I'm not euphoric, and I'm not dismissive. I'm engaged. First, I'm watching whether $85 to $90 holds as a launch zone. If we consolidate here, if we build support, if buyers defend this level, that tells me the rebound is structural, not just a relief rally. Second, I'm watching for a clean reclaim of $95 to $100 to confirm physical alignment. If Western spot prices converge back toward Shanghai pricing, that's your proof that the paper market is reconciling with physical reality. Third, I'm monitoring $70 to $75 as the invalidation level, because if we go back there, if support fails, the thesis changes. That would suggest maybe I'm wrong, maybe this wasn't just a liquidation flush, maybe something deeper is breaking. Based on my analysis, this crash was mechanical, not fundamental. The rebound is structural, not emotional. The fundamental picture for silver hasn't changed. Industrial demand is still growing. Solar, EVs, electronics, all of that is still consuming massive amounts of silver. Mine supply is still tight. Above-ground inventory is still limited. Central banks are still expanding balance sheets. All the macro tailwinds that were in place before this crash are still in place after. Nothing fundamental shifted. What shifted was positioning, and positioning is temporary. If history rhymes and silver holds this support, the move that follows could redefine the trend. I'm not saying we're definitely going to 150 or 250 or 500. I'm saying the setup is there. The weak hands got flushed. The physical market held. The rebound was violent. Those are the ingredients for a sustained move higher if conditions align. But conditions have to align. Liquidity has to cooperate. Demand has to stay firm. Momentum has to build. None of that is guaranteed. So watch the levels. Let the market tell you what's happening. I'm not a financial advisor. This is not financial advice. I'm just a guy watching markets, sharing what I see, trying to help people understand the mechanics so they can make their own informed decisions. Do your own research. Manage your own risk. Think critically. Verify everything I said. Don't take my word for it. Go look at the Shanghai prices yourself. Go look at the CME margin requirements. Go look at the historical precedents. Do the work. That's how you build conviction. That's how you stay confident when markets get volatile. If you made it this far, you're exactly the kind of person who's going to navigate this market successfully, because you're not looking for hot tips. You're not looking for someone to tell you what to do. You're looking to understand how things work. And that mentality will serve you well, not just in silver, but in every market you ever trade. Because markets reward people who understand structure over people who chase stories. If this breakdown helped you see what's happening differently, do me a favor. Share this video. Send it to someone who's confused about what just happened. Leave a comment with your thoughts. And if you haven't already, subscribe, because I'm going to be tracking this closely. We're at a pivotal moment here. The next few days and weeks are going to tell us a lot about whether this rebound has legs or whether we're just in a larger consolidation. And I want to be here breaking it down for you as it unfolds. Stay sharp out there. Think critically, verify the data, and make your own decisions. I'll see you in the next one.